Welcome, everyone. This is Blake Davenport on the LMTR podcast. I'm here today with Brad Lamensdorf, a super talented portfolio manager, here to talk about hot topics and relevant issues in the world of investing and the stock markets. Today is Thursday, March 23rd, 2018. This is episode 1 of a series of mini episodes to come, and we are very excited to bring you these podcasts with some of the most seasoned and brilliant minds in the financial world, like Brad Lamensdorf. In this series of weekly podcasts, we're going to talk about meaty topics relevant to the financial markets that investors like you want to learn about and gain knowledge from. We know our listeners' time is valuable, and we want to add value to your time spent with us. So let's get to it. Brad, I've known you for nearly 20 years, and I never stopped being fascinated by your depth of knowledge and insight in the financial markets. We are encouraged to be on this journey with you, as I know our listeners and myself are going to learn a great deal from you. Thank you for being here. And how are you today?
I'm doing good. Blake, how are you doing?
I'm doing pretty well. I can't believe that you guys in the Northeast have had 4 nor'easters in the last 3 weeks. Wow. How have you guys fared?
It's been okay. The last one was actually pretty weak, so we got off unscathed.
Well, it seems like everything closed except the financial market, so I guess that's good. So, listen, today I want to ask you about some investment opportunities in today's market, or the lack thereof. And I also want to talk about fear and emotion that often comes into play in investing and how to utilize it. Many are saying out there that there are fewer and fewer opportunities to make money by investing long. Do you agree? And what are the best investment opportunities you see over the next 12 months?
Sure. Thank you, Blake. I think that the process is there has been a huge bull market, of course. A lot of stocks have moved out of some people's price range. But when you create a really nice way of investing, a process of investing is usually probably more important than the actual investment itself. We tend to look at a lot of restructurings and a lot of companies that are down and out that aren't very popular at the time. We actually like energy stocks a tremendous amount. They've been thrown out the window and really haven't really participated much with the bull market over the last couple of years. So we don't feel like that they're so pumped up with a lot of the money. Unfortunately, as you mentioned earlier with psychology, sometimes you end up chasing the Joneses. We all remember probably owning too much or too many houses in 07, 06, and what happened in 2008 when they were financed so improperly. And much like today, we think that the stock market is incredibly overowned, and so obviously it's a little more difficult to find companies. But a good process works. We feel like we have a pretty good process of sifting through companies that are coming up from the rubble. So like I said, a great opportunity in the energy patch.
Well, given that the market is so high, and you mentioned 2007 and 8, with a correlation there, do you think that we have, unlike that time, and maybe I don't know what your thought is here, but it seems that today the economy is strong. Yes, it seems lofty, but if we had any meaningful correction, do you think that would derail a strong economy, or do you think the strong economy that we're hearing about is actually real?
I actually do think it's real, and I think that it's accelerating. I think one of the biggest issues inside of the economy from a macro perspective is that our debt, relative to any way you'd like to cut it, debt to GDP, debt to stock market capitalization, is extremely high. So as rates move up, it's going to throw the brakes on the general economy much quicker than it normally would. Although with this newfound cash flow from the tax cuts and some of this regulation busting, there's no question that companies are going to have more cash flow to be able to handle it. Everyone forgets that the stock market crash of 1987, there was no economic ramifications from that sell-off that occurred. It took the savings and loan crisis to pull us into that 1990s recession. So stock markets can depreciate even underneath a very strong economy.
What was the percentage pullback in '87 during that correction?
It was a one-day 21% plunge, but we fell almost 35-40% from top to bottom from the summer of the end of June until the lows in October. So it was as big of a correction from top to bottom as we saw in '08, which was also 41%.
Interesting. Well, speaking of massive corrections, the next topic, fear. Fear's a motivator. Fear motivates people to invest. For example, fear of missing out. That's one way where you feel like you've missed out on a hot sector, and it drives people to invest more. Alternatively, fear of a market correction causes investors to hedge their positions or move to cash. Fear in a panic situation seems to cause investors to make irrational decisions, which can ultimately have a compounding negative effect on their portfolio. How do you use fear in your investment decisions?
It's really funny. Black Friday or whatever comes along as far as like the big Thanksgiving sales, and everybody flocks to them to get their best deals. When the markets are getting really beat up, it takes blood in the street to find some good deals. So people are not well conditioned to buy fear and sell greed, and there's indicators that are non-subjective that we follow. They're more like polls of what people are thinking, and we look at these polls to determine how bullish and how bearish people are in their enthusiasm on their forward returns in the market. So I've never met somebody as a raging bull want to be 100% in cash and miss out on what you call missing out on an opportunity. Inversely, when things are going down, of course, that's very scary looking. So, of course, you want to be in heavier cash. Intuitively, people are better at being invested with the crowd. Last January was one of the highest in 30 years. It was the highest sentiment numbers that we've had in all the different polls that we follow. So we knew trouble was coming because expectation was running so high that it's just very easy to disappoint such a large percentage of people that are already expecting such great things. Just like in 2000, so that's where we were in January and February. 2008 and 9 at the lows, everybody couldn't have been more sour on the market, but yet that was one of the great opportunities to buy. And if you're looking at people's psychology, everybody's laid out for work and everyone's going to be fired. Well, you already know that. That's already in the market. It's been priced in months ago. So it's not as intuitive as it would sound. So process helps.
Yeah, your processes seem to take the emotion out of it.
That's right. That's a great way to. Yeah, exactly. I'm taking the emotion out of the game and giving yourself some rules tend to give yourself a better opportunity to be successful.
Brad, it's great to have you, and I want to thank you for your time today on the LMTR podcast. We look forward to speaking with you next time and to our audience listening.
Thank you.
Thank you all for joining us today. If you like today's episode and you want to stay informed and in the loop with the new episodes as we produce them, please subscribe, review, and share on iTunes and LMTR. Have a great day.